After being ignored by investors for years, dividends are a big topic of discussion again. Why? Let's talk with Simeon Hyman. He's the global investment strategist at ProShares, who runs the ProShares S&P 500 Dividend Aristocrats ETF, which holds S&P 500 stocks that have increased dividend payments annually for at least 25 years. Also with us, Todd Rosenbluth, my old friend, Senior Director of ETF and Mutual Fund Research at CFRA. Simeon, I reported Friday that we are seeing record payouts for dividends this quarter, with big hikes from companies like Halliburton, Lennar, and Wells Fargo. What's going on with dividends right now? I know you emphasized there's been inflows for many years into some of these funds, but it's a topic right now.
Rightly so, but I think the key distinction here, and Todd and I have talked about this for a long, long time, is the distinction between the high yielders and the dividend growers. You can see some outsized increases in high yields from some of the more cyclical players, but really the key is consistent growth of dividends. That tells you that you've got staying power in a name, and you've got that important ability to grow those dividends through a cycle. Extra important in an inflationary environment, absolutely, but consistency perhaps is more important than an unusually large hike that you haven't seen before from some of the more cyclical names.
No, I think that's a very good point. I mean, to me, when we talk about why are dividends a big topic right now, the key point is that when returns on the S&P 500 are expected to be much lower, perhaps, in the mid, single digits, for example, a 2 or 3% dividend return becomes much more important to your overall total return, no?
That's absolutely true, but also because the dividends in the S&P 500 Aristocrats, Nobles, the ETF, because they grow faster than the dividends in the S&P 500, you very quickly, in the course of just a couple of years, get a little bit of cake and eat it too. What do I mean by that? The yield on that original investment compounds much more quickly, such that you really are having not just that small benefit in the initial higher yield, which now is a little higher than usual, about 100 basis points higher, but that delta compounds to 200, 300, 400, 500 basis points of more yield on cost versus owning just the S&P 500. And that's where it becomes a really key part of that longer-term total return picture.
Yeah. Now, Todd, Simeon touched on this, but not all dividend funds are alike. The returns can be different here. Most of the dividend ETFs had returns in the mid 20% last year, maybe a tad below the S&P's 27% return. Those are ones, and I'm excluding high yield. How do you actually make a choice here? Is it as simple as Simeon was saying, or how do you make this decision? Here's some of the returns that we've seen recently.
So I think what's important is that you focus on either dividend growth, companies that have consistently raised their dividends and are likely to do so in the future, and companies that are ETFs that are constructed based on dividend yield. If you want growth, then you want to look into how far back into history are you looking for that dividend growth. So NOBL, which is a ProShares product, goes back 25 years. The Spider S&P dividend goes back 20 years. You've got Vanguard's VIG and the iShares Core dividend growth that are shorter than that period of time. And those two ETFs, VIG and DGRO, include companies like Apple and Microsoft that have grown the dividend for 7 to 10 years plus, but that have not hit the 20 to 25 year mark. And so you don't have technology exposure the way you would in NOBL. You have much more exposure to consumer staples and financials and industrial companies. So you really need to understand whether you're looking for growth or you're looking at yield before you go a step further.
Right. So even this is very sophisticated, Todd. Even amongst aristocrats, there's a difference between those who are growing from 10 years and those who are growing them 25 years. It seems, though, overall, I'm trying to give some guidance to the viewers here. The most important thing is to distinguish between those who are increasing their dividends regularly, whether it's 10 or 25 years, and those who just pay a high dividend. Is there evidence that one outperforms the other long term?
Well, the recent history has been favorable towards the dividend growth-oriented ETFs. So let's use the two Vanguard ETFs that are dividend ETFs that are popular. VIG, which is Vanguard Dividend Appreciation ETF, and VYM, which is Vanguard High Dividend Yield ETF. VIG has outperformed in the last 3 years by over 300 basis points by favoring those more growth-oriented sectors, including technology, as opposed to the above-average yields that you'd find within VYM. So if you looking at the recent past, again, not guidance or not gospel, you can see that VIG was the stronger performer. We happen at CFRA to happen to like VIG more going forward because we think the cyclical slant is going to be rewarding to investors.
Now, Simeon, I know you've said several times in the past that there are fairly consistent inflows into Noble. Do you anticipate they'll accelerate this year? I mean, the strategy you enunciate about why dividend yields makes a lot of sense to me, not only as a hedge against inflation, but if you're only expecting, pick a number, 5% return a year, 2% or 3% dividend yield becomes very important at this point. What are your expectations for Noble this year?
We've seen it already happening. The flows have absolutely been accelerating, not just in the first month of this year, but going into the back half of last year, as well as, to your point, people are really focusing on the dividend piece of the equation for a number of reasons. We mentioned the inflation hedge. We mentioned also the signaling effect, the fact that when companies raise their dividends, they're telling you that the future's looking good. You know, it's a key distinction between dividend growth and buybacks. Todd mentioned the composition. So it's true, Noble, with its 25-year track record, is light on technology. That's one of the reasons why we also offer the Technology Dividend Aristocrats ETF, which is ticker TDV, and that focuses on the Apples and Microsofts of the world that have been growing their dividends, not quite 25 years, but a long time. Technology dividends are becoming an increasingly important piece of the marketplace, and that's a place where that distinction between dividend growth and buybacks is so important. People think it's the same thing, but a buyback is just telling you that the company had good times yesterday, while an increase in dividend, because you never want to cut one, is a much more forward-looking indicator. So both for Noble and Technology Dividend Aristocrats TDV, we're seeing increase in interest and flows in both of those in this environment.